Good day. Andrea is reporting today. I will be discussing exchange rate and risk management with a specific focus on forecasting techniques and managing the uncertainty surrounding these forecasts. This is an essential topic for businesses operating globally, as exchange rate fluctuations can have a significant impact on financial performance. Let's get started. Also, as per instruction of our professor, Dr. Joyce Boda, I will be discussing and differentiating the different forecasting techniques and lastly explain what is the accounting for uncertainty surrounding forecasts. So sit back and relax, listen and watch me report. To begin, let's define exchange rate risk. This refers to the potential for financial losses due to changes in currency exchange rates. For companies that deal with foreign currencies, whether through imports, exports, or international investments, exchange rate risk is something that must be carefully managed. If not, even small fluctuations can lead to significant financial consequences. Managing this risk is a key component of financial strategy in global business operations. Forecasting is one of the most important tools used to manage exchange rate risk. By predicting future movements in currency values, businesses can make informed decisions to hedge against potential losses. There are various forecasting techniques that can be used, each with its own strengths and weaknesses. In the following slides, we'll discuss the four main types of forecasting: fundamental analysis, technical analysis, market-based forecasting, and judgmental forecasting. Types of forecasting techniques. First, we have fundamental analysis, which focuses on macroeconomic data like GDP, inflation, interest rates, and trade balances. The idea is that these economic indicators can provide insights into the long-term direction of a currency. The strength of this method is its broad, data-driven approach, but it can be less accurate for short-term predictions due to time lags in data. Next is technical analysis, which looks at historical exchange rate data to find patterns and trends. It's often used for short-term forecasting and can provide quick insights. However, it only considers past price movements and doesn't factor in external events like political changes, which can sometimes lead to inaccurate forecasts. Market-based forecasting uses current market information, such as futures contracts and options pricing, to predict future exchange rates. This method provides real-time data based on market sentiment, but can be limited to the information available at any given time. Finally, judgmental forecasting relies on expert opinion and intuition. It's often used when there's little data available or in highly uncertain situations. While it can be useful in a pinch, it's prone to human bias and should be used with caution. As you can see, each forecasting technique has its own benefits and challenges. Fundamental analysis is great for long-term predictions because it uses economic data, but it might not be as reliable for short-term movements. On the other hand, technical analysis is faster and good for short-term forecasts, but can miss important external factors. Judgmental forecasting is quick and useful in uncertain times, but lacks the data support of the other methods, while market-based forecasting reflects real-time market conditions, but is limited to what's currently known. Forecasting exchange rates is never 100% accurate. There are many variables at play, from political changes to sudden market shifts, that can affect exchange rates unpredictably. Even the most reliable techniques can struggle in volatile markets. For example, events like political instability or sudden economic downturns can cause unexpected changes that render even the best forecasts inaccurate. This is why it's important to understand the limitations of each forecasting method. Now, let's talk about the uncertainty surrounding forecasts. Uncertainty is essentially the unpredictability or unknown factors that can impact currency movements. Exchange rates are influenced by so many external factors like political events, economic policy changes, and market sentiment that it's nearly impossible to predict them with complete accuracy. This uncertainty can create risks for businesses, especially those heavily reliant on foreign exchange. To address this uncertainty, we have several tools available. Scenario analysis involves creating different possible future scenarios, such as best case or worst case situations, to prepare for a range of outcomes. This helps businesses plan for various potential currency movements. Sensitivity analysis examines how sensitive a forecast is to changes in key variables, like interest rates or inflation. It shows the potential impact of those changes on exchange rates. Lastly, value at risk VAR quantifies the potential loss in a currency over a specific period, assuming normal market conditions. It's often used in risk management to gauge how much a business might lose under different circumstances. One of the most common strategies for managing exchange rate risk is hedging. Hedging involves using financial instruments like futures, options, or forwards to protect against unfavorable currency movements. For example, a company expecting to receive payment in a foreign currency might enter into a forward contract to lock in a favorable exchange rate today, thereby reducing the risk of the exchange rate worsening before payment is received. Hedging helps companies manage risk by providing more certainty in their financial planning. There are other strategies businesses can use to mitigate the risks of inaccurate forecasts. One is diversification by spreading their revenue and investments across different currencies. Businesses can reduce the impact of currency fluctuations on any one currency. Another strategy is regular monitoring of economic indicators and adjusting forecasts as new information becomes available. Forecasts should be flexible, and businesses should be ready to update them frequently to reflect the most recent data. To summarize, exchange rate risk management is crucial for companies engaged in international business. We've covered various forecasting techniques such as fundamental, technical, judgmental, and market-based methods, and how each offers unique insights into predicting exchange rate movements. However, uncertainty is inevitable, and businesses need to account for it by using tools like scenario analysis, sensitivity tests, and hedging strategies. Ultimately, a combination of accurate forecasting and risk mitigation strategies will help businesses navigate the unpredictable nature of foreign exchange markets. Once again, Andres reporting over and out. Thank you for listening and watching.